Hello friends, welcome to my video on cost and management accounting. In this video I will be explaining one example of alternative course of action under the chapter cost volume profit analysis. Okay, now what is alternative course of action? Sometimes a company may be having more than one products. Okay, the management might have decided to maybe discontinue any one of the products. Now in deciding the discontinuation of the product, management may be in dilemma which product has to be discontinued so that the company will earn more profit than continuing that product. For example, a company is having 3 products A, B and C. The management is thinking that it is very difficult to manage all the 3 products A, B, C, so it is deciding to discontinue one of the products. So which product has to be discontinued, which is called as alternative course of action. So in this video we will be seeing one example of measuring the profitability, what is the impact on the profitability of the company when they discontinue one of the products. Okay, so let's see. So in deciding alternative course of action, it shall be kept in mind that whatever course of action is accepted, the fixed expenses will remain unaffected. So that has to be kept in mind. Okay, the fixed expenses what the company is already incurred or it is going to incur in the name of fixed expenses, that will not change, that will remain same. Okay, that is first point to be noted. And then which product has to be kept, so we have to consider only the marginal cost or the variable cost, so that has to be considered. So therefore the criterion which weighs is the effect of alternative course of action upon the marginal cost. What is the impact on the marginal cost, and so that impact on the revenue or the profit obtained, so that has to be considered. So the course of action which yields the highest contribution is the most profitable, and that has to be followed by the management. So which course of action? Suppose if the management wants to decide to remove one of this product and to keep 2 products only, so which of these 2 products has to be continued and which one has to be discontinued? So the criteria is simple. Criteria is which combination is giving more profit or which is giving highest contribution. So how to calculate this contribution? So let us see one example here. There is one example problem. So the cost per unit of 3 products A, B, C is given here. Material cost, labor cost, variable overhead, fixed overhead, total cost, profit and selling price. Okay, and number of units produced, all these details are given for all the 3 products. Now the production arrangements are such that if one product is given up, the production of the remaining products can be increased by 50%. Okay, suppose if the product A is discontinued, product B will be increased by 50%, product C will be increased by again 50%. Similarly, if the product B is discontinued, product A will be increased by production 50% and production of C will be increased by 50%. So that is the arrangement. So here the directors propose that product C is to be given up. So the managers, the directors decided to give up this particular product. So do you agree? Give the justifications. So this is the problem. So by now, as of now, the existing profit of this product individually is this given here in rupees. Okay. So now let us calculate the profitability of each combination, so that which combination gives maximum profit, that has to be maintained and the one product can be discontinued. So first calculate the fixed expenses in the present arrangement. As of now, what is the fixed cost? So here you can see fixed overheads, right? Fixed overhead, and that is per unit. So for product A, 300 rupees per unit, and units produced is 1000. So if you multiply the fixed overhead per unit and number of units, you will get the total fixed cost of product A. Similarly, fixed cost of product B and number of units, 300 into 500 rupees. Similarly, 200 into 800 rupees, you will get the total fixed cost. So this is how it is calculated here. Okay, units produced and fixed cost and the total, and this is the grand total of the fixed cost, or the total fixed cost of all the three products. So whatever you do, this will remain same. Okay, this will not change. Okay, you drop or you continue a product, this will be remaining same. 6,90,000 you have to spend on the as this fixed cost. Okay, so that has to be kept in mind. So that is the first step in the calculation of the fixed expenses, total fixed expenses. And then we can analyze the per unit contribution by from each product. Okay, per unit contribution from each product. So you can calculate contribution per unit is equal to selling price minus the variable cost. So product A, it is 3,200 rupees selling price, and the variable cost total. So you can get it here in the table. Selling price is given here 3,200, and the variable costs are these. Okay, direct materials, direct labor, and variable overheads. The total of this 3,200 minus 2,000, so it is 1,200. Similarly, here it is selling price is 3,000, and the total of these three. Okay, 8,000, 800, 500, 1,300, 1,300 plus 700, 2,000. So 3,000 minus 2,000, 1,000. So this is how the contribution per unit is calculated here. Okay, so 1,200 from product A, 1,000 from product B, and 800 from product C. So this is the contribution per unit as of now. Okay, now let us see one by one. Situation 1. So three production arrangement, alternative production arrangements can be. Number 1, if product A is given up, suppose if we drop product A, then product B and product C will continue, and it will be, the production will be increased by 50%, right? So that is the condition. So then the B's output will be, as of now it is 500 plus 50% of 500, so that is 250. So total production units will be 750. Similarly, C's output will be, now it is 800, and it will increase by 50%. 800's 50% is 400. 400 plus 800, 1,200. So 1,200 units will be the new production units. Okay, so now for this new production units, what is the contribution? So B's contribution, this 750 units multiplied by contribution per unit we calculated just now, so 1,000. So 750 into 1,000. Similarly, product C's contribution, 1,200 units into 800 rupees contribution per unit. Okay, so that is 9,60,000. So total contribution will be 17,10,000 rupees, and less total fixed expenses. So you know, contribution minus total fixed expenses, this we calculated 6,90,000. So that will give you the profit. So from this, when you drop product A, okay, your profit will be 10,20,000 rupees. Similarly, situation number 2, when you are going to drop product B. Okay, if you drop product B, product A will increase by 50%, product C will increase by 50%. So A's output 1,500 units, C's output, as we already saw, 1,200 units. So contribution 1,500 into 1,200, 18 lakhs. C's contribution 1,200 units into 800 rupees, 9,60,000. Total contribution, fixed expenses same, 6,90,000. So when you drop product B, profit will be 20,70,000 rupees. Okay, and the third situation is if the product C is given up, product A and B will be increased by 50%. So similar calculation, and ultimately you will get a total profit of 18,60,000. So now in these three situations, okay, where we are getting maximum profit. So here it is 18,15,000, and in the previous case it is 20,70,000, and in the first case it is 10,20,000. So in the second case the profit is highest, 20,70,000. So you can drop product B and you can continue product A and C, so that your profit will be maximum. Okay, profit will be maximum. So to conclude, from the three production arrangements we see that the profit is maximum when the product B is given up. Therefore we do not agree with the directors that product C should be given up. So directors propose that product C should be given up. So that is not feasible and that is not profitable. So we do not agree with the management's decision. So and we strongly recommend to drop product B in order to have the maximum profit. So this is how this particular alternative course of action has to be considered. Okay, thank you, bye bye.